tax crash course every bookkeeper must know without becoming a CPA. So in the next few minutes, I'm going to break down exactly what you need to know about taxes as a bookkeeper and what you absolutely should not touch unless you want angry clients, messy books, and a CPA slightly judging your entire existence. Let's fix that. First things first, if you're a bookkeeper and you're not a tax expert, good, you're normal. Most bookkeepers are not CPAs, and most CPAs are not bookkeepers. But here's where most people mess this up. They think bookkeeping is just categorizing transactions, reconciling accounts, clicking buttons in QuickBooks. No, that's like saying flying a plane is just pressing buttons in the cockpit. Bookkeeping is the cockpit. Taxes, air traffic control. Different job, different responsibility, different consequences. And if you mix them up, things get expensive fast. So let's get crystal clear on your lane. Mistake number one, trying to be the CPA. A lot of bookkeepers think if I just learn enough tax stuff, I'll be more valuable. Wrong. What actually happens is you slow yourself down, you overthink client work, you start giving tax advice you shouldn't, and you still get paid like a bookkeeper. So instead of trying to become a tax expert, you need to become a dangerously good bookkeeper who understands tax context. That difference, that's where the money is. So rule number one, know the entities, aka what game the client is playing. Different business structures equal different tax rules equal different expectations. Here's the simple breakdown. Solo business, Schedule C. Think freelancer, solo operator, filed with a personal return 1040. Business activity lives inside one form, simplest structure. S-Corps. Think optimized small business owner trying to save on taxes. Separate business tax return. Owner also has personal return. Payroll plus distributions combo. Partnerships, Form 1065. Think two or more owners. Shared business tax return. Profits flow through two owners. More complexity, more coordination. Corporations, Form 1120. Think formal business entity, less common for small operators. Separate tax entity entirely. And nonprofits, Form 990. Think mission-based organizations, totally different reporting rules. Now, here's the key insight. Nobody tells beginners. You don't need to master these. You just need to recognize them fast so you don't mix up expectations. Because if you treat every client like a simple freelancer, you'll eventually mess up a multi-entity business, guaranteed. Rule number two, what the CPA actually wants. Let's say you hand off books to a CPA. What do they actually care about? Not your fancy categorization, not your color-coded spreadsheets. They care about one thing. Can I trust these numbers? That's it. All transactions included, no missing months, all accounts fully reconciled, bank balances match reality, loans actually match loan statements, categories are consistent, not random every month. Also, big one, if owners are mixing personal expenses into business accounts, those do not belong on the profit and loss. They go to owner draws, not expenses, not deductions, draws. Rule number three, you need to understand the tax timeline, not just deadlines. Most bookkeepers think taxes are just April 15th stress. No, taxes are a year-long rhythm. Here's the reality. Some businesses file in March, some in April, some in May, some extend to fall, and that's just income tax. Now add payroll cycles, sales tax, extensions. So if you don't understand timing, you constantly feel like everything is urgent. Because to you, everything is urgent. But to professionals, it's a cycle. And once you see the cycle, you stop panicking and start planning. Rule number 4, depreciation. You don't do it, but you can't ignore it. Here's where bookkeepers either overstep or completely ignore it. Both are wrong. Your job is simple, and here's rule number 4. If a business buys something significant, equipment, assets, improvements, you don't expense it randomly. You put it on the balance sheet. That's it. Let the CPA handle depreciation. Think of it like this. You're placing the asset on the correct parking lot. The CPA decides how it depreciates over time. Also, simple rule of thumb, if it's a meaningful purchase, it probably belongs on the balance sheet, not expenses. Rule number 5, deductible versus non-deductible. Here's the truth. Most business owners think if I spent money, it must be deductible. Yeah, no. Real rule, only ordinary and necessary business expenses are deductible. So what does that actually mean? Normal for the business, needed for operations. Here are some common traps. Entertainment, like games or events, not deductible. Fines and penalties, not deductible. Personal spending, not deductible. Taxes paid personally, not deductible. And meals, sometimes partially deductible, but must be tracked separately. Here's the bookkeeper golden rule. If you lump everything into miscellaneous expense, you're making the CPA's job harder and reducing your perceived value. Rule number 6, know your lane. And this is the part nobody wants to hear. Your job is not tax strategy, tax projections, legal structuring, estimating tax payments. That's CPA territory. Your job is clean books, accurate categorization, reconciled accounts, structured financial data. And here's the mindset shift that changes everything. You're not the expert on everything. You're the expert on clean financial reality. And ironically, that's what makes CPAs love you. Because when they trust your books, everything else becomes easy. All that said, let's simplify everything into one idea. You are the person who turns messy financial chaos into structured, usable truth. That's it. Not taxes, not strategy, not advice, truth. And when you stay in that lane, clients trust you more, CPAs respect you more, your workflow gets faster, and your business becomes way easier to scale.